Welcome to TheoTrade. This is Don Kaufman. It's October 4th, 2019, and you are watching the TheoTrade Weekend Update. This has been a rather spectacular week for retail traders on a number of fronts. I mean, one of the things, obviously, that we've got to discuss, the title of this weekend's update, the truth behind commission-free trading. Brokerage war heats up, and the brokers effectively drop stock commissions to zero. You know, the irony of that is everybody's talking about the brokers, they're fighting. Charles Schwab kicked off the brokerage war. It was met then by TD Ameritrade. E-Trade followed suit. They all jumped in. Listen, people, okay, the war, it's over. You are the winner. And I cannot stress that enough. Now, I know that a lot of people, because we were flooded with emails this week, a lot of people kind of believe behind the scenes there's something very nefarious going on in the brokerage world. How are the brokers possibly going to profit? Listen, they're going to take a big hit on this, all right? It was going to happen. This is something that has been planned for in the brokerage side of the world for many, many years. So I think that I'm probably relatively qualified to discuss a little bit about commission-free trading. For those of you that may or may not necessarily be aware, I spent 15 years in the brokerage world, both at thinkorswim, when thinkorswim was a startup brokerage firm. Then, of course, we were acquired by none other than TD Ameritrade. I spent 5 years at TD Ameritrade running their education division. And in 2015, I finally left, after, again, pretty vast career in the brokerage business. So I have a very detailed understanding. I still stay up to speed on a lot of the regulatory environment and a lot of the structure, if you will, of the market environment. So with that, I'm going to try to provide you just a little bit of insight, to commission-free trading. Because as I said, even, as far back as I can remember, this was always the goal, people. And that's what a lot of people don't get about the brokerage world. This was the goal, to go commission-free, It's utopia out there versus what it used to be. And as I said, people are talking about the commission war heating up. As I said, it's over, You are the beneficiary now of brokerage firms, infighting. With that, let's get down to it. So, as I said, we're flooded with emails, and one of the first things that was really, I think, one of the questions is, how do the brokerage firms, how do they profit? How do they profit when you are able to trade stock? Well, for free. By the way, here we are. We're after markets. And in after markets, the bid-offer spreads do widen out. That's normal. But if you looked at the marketplace, during live market conditions, the bid-offer spreads are still going to be what we term penny wide. So for those of you unaware, what a penny wide spread means, it means it's like, 27, for instance, 41, at 27, we'll say 42. That's a marketplace. Now that marketplace, is that really going to change? Like, is that bid offer spread going to widen because they went to commission free trading? And my feelings on this, absolutely unequivocally no. This bid offer spread is not going to widen out. It's one of the questions that's come up. Why would the bid offer spread widen out? When I say the bid offer spread, listen, when you go out and buy something, you're buying it, for instance, for $27.42. 2 seconds later, you can sell it, for $27.41. All right, and the market maker or liquidity provider gets to actually keep effectively a penny. So if you were to go out there and you were to trade like 1,000 shares, what are they really making? Well, the liquidity provider is going to make what? 1,000 shares worth a penny. They're going to make $10. And that is, again, this liquidity provider. When I say liquidity provider, I know it sounds so evil, market making firms, They're giant internalization engines that trade stock. And I'm going to tell you right now, if these liquidity providers, if they started to widen out that market, if they started going like 27.40 at 27.42, guess what? Another firm would open up their doors tomorrow and they would make liquidity in here and they'll tighten up the market again. You have no worry whatsoever, I believe, on markets widening out on that particular front. So how do brokers actually profit? Well, let's get down to it. Now, this is like, the dark side of this. Listen, it's not all that dark. These brokerage firms, okay, sell their order flow. They have always been selling the order flow ever since I've been involved in this industry. I got involved in the industry in the late 90s. Okay, ever since I've been involved, they sell flow. And when I say sell flow, okay, when you go out and you route an order, when I say route, when you go and you send off an order, for instance, on a platform like this, okay, that order doesn't necessarily go to a major exchange. Like your order is not going, for example, specifically to Nasdaq marketplace. Forget that. Okay, your order goes to a liquidity provider, a market maker, and that market making firm, okay, in turn will actually turn around and pay the brokerage firm, okay, a fee for sending the order. Why? Why would they do that? Why would that liquidity provider? They want your trade so bad, okay, that they're willing to pay for it. I'll tell you exactly why. Okay, well, I just mentioned it a moment ago, because they get to capture, if you will, okay, that penny. And they get to capture that penny. If you trade 1,000 shares, okay, great. Then they get to capture, for instance, $10 in there. But I'll tell you what, it doesn't sound like a lot because you're like, well, I only do 100 shares. Well, so what? So what? They collect a buck. But they do this tens of millions of times a day. And when you do it tens of millions of times a day, it really starts to add up. And because it adds up, okay, to that market making firm or liquidity provider or an internalization engine, by the way, those are all terms that you can use, okay? They provide payment back to the brokerage firm, okay? And that's what they call payment for order flow. And that's, it's the dirty little secret. Yeah, well, that dirty little secret hasn't changed the structure of the marketplace, okay? It's still incredibly tight spreads, except you don't have to pay, the $6.95 plus the bid offer spread. Now, basically, you're just dealing with the bid offer spread. Okay, so how are brokers going to profit? Well, they're going to get paid on that order flow. And the same is true inside of the options market. And in the options market, again, to be fair, hey, look, liquid markets in here, they're usually penny wide. You cruise over to the spiders, okay? The spiders will give you penny wide markets like all day long. So one of the keys to this being effective for you is trade really, really liquid products. The more liquid products, hey, the commissions are next to nothing. The bid offer spread's next to nothing. As I said, this is like utopia. Now, people, of course, again, they're like, nah, there's something nefarious going on. Is there a dark side to free? I'll tell you what, I would say that the biggest dark side to free is your ability to go hog wild. Huh? Yeah, you're going to do it too. You're going to go out there and you're like, I bought 100, I sold 100, I bought 100, sold 100. Okay, don't go hog wild. But you have to realize, I don't look at this as being a dark side. Okay, you get to experiment and not have to necessarily paper trade. Listen, I've been doing this. Pretty much I've been around trading my entire life. And as I said, I spent 15 years in the brokerage world. And everybody likes to paper trade when they first start because I got to get my feet wet. Listen, you want to paper trade? Paper trade to learn the technology. Okay. After you understand the technology, go to town, people. Now you can route orders in the spiders for free. Why do I jump to the spiders? Look at this. It's going to be a penny wide market, bid offer spread. You got to pay what? 65 cents a contract on options? Oh, by the way, 65 cents a contract on options. That is my rate. Okay, I worked there for 15 years and I was paying 65 cents a contract. By the way, I'm a little aggravated about that because I actually feel that they moved it to 65 cents a contract just to jab a knife right in my side. They're like, look, Don, we moved it right to your commissions. But that's all inclusive too. It's spectacular for stocks and options. Now, another question that comes up, they go, what about futures? Futures has a different structure entirely. Now, don't you expect futures commissions to come down substantially because, okay, the futures market doesn't have that payment for order flow, okay, like they have, again, in the spiders, like they have in equity products, like they have in ETF products, like they have in option products. Futures, completely different regulatory body. It's the NFA and the CFTC, whereas the stock and options market is the SEC and FINRA. So again, completely different marketplace. Don't expect those big commission breaks over in the futures side of the business because I'm sure many of you are calling up your brokerage and be like, come on, give me a better futures commission schedule. So I'd say the dark side of this, overtrading, but at the same time, you get to go out there. The way I think about this is trading, it's a little bit of a sport. You could read everything about playing the game of golf, but you go out there on some course and you try to hit a ball, you're going to be like, wow, I am absolutely horrible. That's the same thing with paper trading. In paper trading, everybody's a genius, right? Now you can go out and you can actually trade for free. So all you're going to do at that point is just, give up a little bit of bid offer spread, learn the ropes over there, get comfortable with the technology. It's spectacular. As I said, the dark side to me is you over trading. Be a little careful, okay? Try to keep yourself relatively constrained. Now, I was having a difficult time with that. And by the way, speaking of a difficult time, I want to show you something. People, again, they don't like this idea of the bid offer spread. They don't like the idea of liquidity providers. I'm just going to highlight something on the screen because over the last couple of days, since we went to quote unquote free commissions, with the free commissions, listen, I went out there just to elaborate upon. I went out and bought earlier today at 27.11. That's where I put my limit order, and they filled me, if you will, 1/1000th of a penny better. That's because the liquidity provider wanted my trade so much that they gave me 1/1000th of a penny better. Okay, and on the way out, you can see I actually filled on the way in. All right, which was 6:58 in the morning. Then 8 minutes later, I sold it. Okay, and it's kind of fun because I sold it for a whopping 3 penny gain. But I don't have to pay commissions, right? So if I don't have to pay commissions, who cares? 100 shares, I just made $3, $3. But I want to show you, I didn't fill at 27.14. Okay, they gave me a fill at 27.14, half a penny better than I was expecting. So what's so dark about that? It's not. By the way, you have to recognize also with all this commission-free talk, do you understand the strategies this is going to open up? Okay, gamma scalping. It's going to be a free-for-all. This is going to change the way we as retail clientele are going to trade. Okay. Now, for those of you that trade intraday, there are strategies, things called like gamma scalping. Okay. I'm going to be a gamma scalping fool given the fact that I don't have to pay any commission on my stock. I could buy and sell, 100 shares of spiders like it's water, and I can offload my delta risk all day long. It is beautiful. The $5 or $6 that you used to pay for commissions was, again, it was difficult. It was hard to overcome, but for gamma scalping, it's on. So the real truth behind commission-free trading, the brokerage war, it's nothing but good. It's nothing but good. And you know what? People are worried about, well, what happens if they change the market structure? What happens if this payment for order flow goes away? Listen, once the brokerage firms go down to zero, there ain't no coming back, people. They're not going to raise up their commissions after this. They can't, because you know what? Somebody will always be willing to do what? For nothing now. So it has changed the landscape of the retail brokerage firm. It's now, to me, okay, when I'm selecting my broker, hey, if they're all free, I'm just going to stick with whoever has the best technology. Plain and simple. The best interface to the marketplace. I don't want to hear anymore. This person has slightly better commissions, okay? That's gone. Even on the option side of it. And by the way, I've looked apples to apples on the option side, okay? One of the great things, there's all these different fees that get tacked in. Look for a brokerage firm that's all-inclusive, meaning that the fees are included. Like if you trade SPX, there's usually fees tacked on, or the VIX, there's fees tacked on. Look for a brokerage firm that's all-inclusive. To me now, it's all about technology. With that, that's to me, that's the truth behind commission-free trading. I think it's absolutely spectacular. And, having spent 15 years in the brokerage world, hey, listen, the brokerage world, their days of being fat and happy are over, okay? They're going to be slimming down. I would expect some layoffs, unfortunately, inside of the retail brokerage space. And with that, hey, listen, for you being a retail trader, all you have to pay for now is some education. You got to get yourself educated, okay? Because it doesn't cost you anything to trade now, all right? So you got to spend time and some effort getting to know trading. With that, let's actually get down to what happened this past week. Well, this past week in trade, we had weakening data. ISM manufacturing, ISM non-manufacturing, those numbers, That was a not good. And then the jobs report came out today. That was on Friday, October 4th. And the jobs report, kind of a big question mark. But I got to tell you, the ISM non-manufacturing number really kind of iced the cake, in my opinion, for the fact that the marketplace, well, is in for a global slowdown. But the market loved it. I'm going to come back to that in just a second. So think about this. You're getting weaker data, but the market loved it. Like the weakest of the weak data was the ISM non-manufacturing. I mean, listen, we're a services economy, and that was right down here. When that number came out, the market tanked, and then it ripped. And that's absolutely no surprise to see the market bounce back up. I'll come to that in just a second. Now, before I go any further, you have to love that, right? Really, really bad data. We should totally rally on that. Before we go any further, I want to reiterate a couple of gravity points here. The 2911 gravity point. That thing was gold, people. Okay, I told you on Wednesday night. Okay, on Wednesday night before the ISM non-manufacturing number came out, it was a simple binary trade. We were either going to 2842 or going to 2911. You realize we literally closed on Wednesday, okay, or Thursday, I should say. I apologize. On Thursday, we closed on Thursday at 2911. We broke off on Wednesday from the 2911 to head down. We almost touched all the way down, okay, to our 2842 gravity point. Nevertheless, okay, it was pinpoint accurate at the 2911 level. Okay, historical volatility. This is actual price movement in the marketplace. This is something that you might want to start to be a little bit concerned about. And that has to do with, well, I'm going to pull up a study. We're going to come to add study all the way down to volatility studies, cruise up here to historical volatility. This is an average of 20-day historical volatility. Put that aside for just a second. I actually want to knock that down to 5-day historical volatility because I just want to show you how vicious price movement got. So all of a sudden, markets were in a lull for literally the month of September. Okay, the month of September, we just channeled. We had a lull. Bam. We hit October. We are flying right now in historical volatility. Historical volatility is actual price movement. So one of the things I want to point out, and I'm actually going to cruise over to the spiders for this. One of the things I'm going to point out inside of the spiders, we were inside, okay, during the month of August, what we termed a volatility box. Okay, the volatility box, pretty simple idea. All right, when you're in a volatility box, we just ping back and forth. Okay, from some specific gravity points, specific levels. Now, okay, one of the things that's kind of astounding, we dropped right back into that same volatility box. Okay, but picked our head up out of it. Okay, today on October 4th, specifically today, coming into next week. One of the critical things. If we start dropping again back into the volatility box, okay, it's just no holds barred at that point. It's going to get wild. Okay, I'm telling you, in like Monday, Tuesday of trade of this next week, Monday and Tuesday of trade this next week are pivotal times because we are right at the upper edge, literally stacked to the upper edge of the volatility box. We have not per se broken outside of it. And I believe that we have a pretty good probability literally of dropping right back into it. And then it's, as I said, it becomes like no holds barred trading inside of here. And that volatility box, it's awesome. It's awesome for in-out spreads. It's going to be wonderful for a lot of the strategies that we employ. A bid back to the upside, well, that leaves us in a little bit of a lurch. Not necessarily a horrific thing. It'll leave some opportunities because volatility will crush down, though, if we go back up. But I wanted to leave you with that because historical volatility, actual price movement is really picking up. By the way, the next thing I wanted to talk about is markets going nowhere. When I say markets are going absolutely nowhere, have you pulled up? I'm just going to pull up like a 3-year chart. If you pulled up a 3-year chart, you're like, wow, that's a spectacular rally. Yeah, but really, okay, for the better part of the last 2 years, we're doing a whole lot of nothing. I just wanted to throw that out there because in a whole lot of nothing, all right, I choose, and I'm going to show you this in just a moment, in a whole lot of nothing because we're pretty much, doing a lot of nothing other than channeling effectively up and down over the last 2 years of trade. Oh, yeah, that channel's become a little bit higher, but this is just chopped out volatility, right? Bear, okay, spreads are a little bit cheaper. Bear spreads are cheap versus the call spreads. That's one of the points I wanted to make. If markets are going nowhere, okay, and they're just channeling back and forth, I would actually rather place more bearish trades than bullish trades. And I'm just going to throw this out there for your consumption, whether you like it or not. I'm just telling you, okay, the bearish spreads are pricing more effectively. You're like, I don't want to hear it. You don't have to hear it, but it's true. All right, let me show you. If you take a look at a spread, now we're at what? 294.35. Okay, the skew inside of like the spiders, for example, is kind of pitted a little bit against the bullish side of the marketplace. If I do like a 293, for instance, 295. Now, granted, this is a spread that's in the money by $1.35. You could buy the spread for like $1.35. I get it. It's not the perfect example, but on the flip side of this, and I'm actually going to throw in a different type of order over here so you can see both of them next to one another. If you look at the flip side of this particular order, I could do something over here like the 295. I'm going to go buy up to vertical. Okay, 295, for instance, 293 spread is trading for about 70 cents. Okay, the put spreads, because of the implied volatility skew, are trading for drastically less than the call spreads. Now, okay, that example, you're like, I don't know if I necessarily understand. Come on, let's go to another expiration. Let's see if we can really kind of clarify and quantify this, even in the shortest duration possible, okay? When you start looking at markets, the call spreads are simply trading for more. Again, we can go 12 days out, we can go 14 days out, whatever you're comfortable with. But in this case, I'll even go to the 294, 295 spread. Now, the 294, 295. Now, I wouldn't normally do a dollar wide spread, and I wouldn't do a dollar wide spread. But what I want you to see in this case, because I think this will actually paint the picture the best, is that in this dollar wide spread, it's trading for 62-cent debit. Okay, the spread's only in the money by 35 cents. But if you take a look at the opposing spread would be, again, the exact same spread as a put spread. Go over here to buy vertical. Okay, and the put spread is trading for 38 cents. You're like, wait, what? Okay, because the 95 puts are already in the money by 65 cents, yet the spread is trading for 38 cents versus the call spread that's trading for 62 cents. So in a market that's going nowhere, it's actually more effective to place more bearish trades than bullish trades, okay, if we continue to kind of channel back and forth. That's why I was talking about like this volatility box. This volatility box, it's just bliss. And I'll tell you why it's bliss, because we go down and then we go up and then we go down. Okay. And every time we go up, we get bearish, and we go up and we get bearish again and make profitability out of that. So, hey, listen, we drop back down to that volatility box. It's a party because I've already got some in-out spreads waiting for it. Now, next thing on my list over here, what I call the circle of risks. The Fed. Listen, I'm going to be quick about this because the Fed, they're going to be speaking throughout the course of this next week. The next Fed meeting, it's got a ways till it's actually going to come up. But I wanted to show you some of the Fed probabilities. Fed probabilities soared this past week. Why? Why did the Fed probabilities soar? Because there was bad ISM data. I mean, effectively, okay, the chances of another rate cut right here in October. Okay, hey, we're in October, the day before Halloween. You want a Halloween gift? There it is. There's about a 76% chance of another quarter point cut. That's what they're saying. Okay, check this out. You can actually see total probabilities, all right, of easing, 76% chance, 25 days to the next meeting. Okay, but then they're pricing in a 90% chance, okay, of at least like one rate cut in the next 67 days. It's kind of cool. Figured you guys would appreciate that. And you ask, like, why did the markets soar? Right there. The markets were soaring, okay, the last two trading days on Thursday and Friday because the probability of a rate cut and return of quantitative easing, okay, it's happening. Okay, we're already talking about the return of QE. So markets initially love lower rates, okay, and QE, but real numbers now support a global slowdown. So you're in a little bit of a catch-22 in the very near term. Okay, in the very near term, markets love rate cuts, but if you look back, even to like 2007, 2008, they're cutting rates. For those of you that remember this, in early 2008, before the financial crisis really hit, there was an emergency rate cut, okay, and the market loved it. And then we completely and totally fell apart thereafter. But there's a bigger problem out there. There's clearly a bigger problem. Listen, the repo market, still there's no definitive reason of why the repo market seized up. And this should be a little bit of a stark warning. Did you know that Japan, as of this week, they're going to actually slow down the whole idea of quantitative easing? Why? Because it's not working anymore. They basically said that quantitative easing and negative interest rate policy is becoming, well, deforming pretty much their entire economy. You have to love that because we're headed into it, and they've been into it for what? Decades! Literally decades. It ain't working. They're starting to appreciate the fact that it's not working, but don't worry because we're headed directly into it. Again, it's some dark, topics of conversation over here, but I call it's the circle of risks. The next risk on there is going to be trade war. That's going to come up a tremendous amount. But the trade war discussion this week, that's just going to be a tweet-filled fun fest. Next, earnings are coming. Listen, earnings! The first earnings that are going to be up are typically going to be things like Bank of America, the big banks out there. They're going to start to release, the Goldman Sachs of the world. It's a party, people. But you're going to have banks releasing. You're about 2 weeks away from the banks' earnings, though, are coming. And again, it kicks off with the banks. Keep an eye on that. The last thing I'm going to mention here, before I go over to a couple of individual products, expected move. Okay. This is another thing, like along this circle of risks, you need to be aware the SPX expected move. Now, let's cruise over to the SPX. When I'm talking about expected move, this is how the option market depicts risk moving forward. This past week, this is the week that just passed right here, we were sitting with almost a $55 expected move. That effectively means we're supposed to move 55 higher or $55 lower. Did we move 55 lower? Oh, and then some. We actually tagged all the way down just below 28.60 and then we ripped. What's crazy about this week, as I said, that volatility really expanded out. But the week started right here. What's right here? About 29.60. Where did the week end? 29.52. Do you realize after all of that, we went absolutely nowhere? I mean, the market finished within $10 of where it was. Was it a down week? Sure, by some standards. Okay, not much of a down week over there. But what's actually a little bit alarming is even after this wicked rally, they didn't back down that volatility at really all. I mean, listen, we go from a 55, expected move to a $53 expected move. So, hey, what do you learn from this? Get ready to rumble. There's going to be some more volatility hitting in this next week of trade. So keep your helmets on. Other aspects I want you to be aware of. You realize the financials, they touched all the way down to 26.50 before ripping. I still see considerable risk in here. If you're not short the financial markets, let them open on Monday, Tuesday. Okay, let the financials possibly take back off to the upside. It could be a nice short position. Throughout the course of the week, okay, I'm going to be elaborating on, again, a couple of more positions, in-out spreads, infinity spreads. Stuff is working right now. And the last thought I'm going to give you, okay, the financials were covered. But do you realize that the bonds are still exploding to the upside? Okay, and people, we got to trade on for this. We actually have an infinity spread specifically inside of the TLT. The TLT, it's working as the TLT continues higher, right? That's actually taking interest rates, the TNX, back down. We're really close to touching into some recent lows on the interest rates. Okay, if rates come down back to about 1.4%, S&Ps once again could freak out because that's not going to be good. That is not going to be good in any way, shape, or form for those financials. A lot of risks on the very near horizon. Hope you guys enjoyed this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.